What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Today, I'm joined with Ben Nelson. How you doing today, Ben?
Good, man. How you living?
I am fantastic because I don't know if you realize this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, that means investors, it means operators. Sometimes it's construction, all sorts of different people. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of an off-market deal, a private deal that you're not allowed to talk about with the public, you know that with 506B syndications, you need a documented prior substantive relationship, or else the SEC will get ants in its pants and pull the rug out from everybody. And so it's important to know level of sophistication, appetite for risk, all that kind of fun stuff. And the benefit to you is you will learn how to express yourself and communicate effectively on the subject of commercial real estate, which quite frankly, I think that everybody's career in this industry depends on that. But before we get too deep into real estate, Ben, do you want to say a thing or two about yourself?
Yeah. Hey, so I started a long time ago producing action sports events, and that's where I grew up. And I loved the puzzle. And it just came to a spot where I loved what I was doing, but it just wasn't serving myself or my family. I was gone all the time. So myself and my brother and two other partners pivoted into Wild Oak Capital. We operate in Texas, Oklahoma, and Arkansas primarily, value add space. A lot of 506B deals. So a lot of what we're talking about here is incredibly important to.
Okay, and now we'll pause. Sorry, you
Yeah,
were
so
saying.
the 506B space is incredibly important to us, and understanding the ins and outs and being really smart about it. I think, unfortunately, there's a lot of people that know either A, don't know the rules, or B, kind of just ignore them a little bit and hope they're going to get away with it. I'm sure you've seen both of those things in your space. So that's what we're into. And we love working with people. Our biggest thing right now is building community, the ebbs and flows of how this market works. We're in a space where we're trying to build as much community as we possibly can. And by that, I mean, we love working with like-minded people, whether it be people that, I'm an adventurer, people are outside, they're dads, my brother's dad, we have those spaces. My brother's an engineer, other partners in the oil and gas space. So we love working with people that have not only like minds, but have like living. And we want to help people as much as we possibly can, right?
I love that answer. I love that answer. And yeah, it's always funny because whenever somebody sends me a deal, I'm like, well, I know whether you're compliant or not. And so that's a little advantage that not everybody has. But the first segment that we always do here, I always go through the five distinct motivations. Before that, I got to say, but wait, check your eight. Ben, I don't know if you can see through the camera and down there, but there might be this hideous subscribe button in the user's device, and maybe they should just, oh, okay, it's a
Just
stupid
go ahead and
joke.
click it. Got it.
Exactly. But the five distinct motivations, it's absolutely pivotal in this industry to know why people are in the space because after all, the deals take months to close, they take years to go full cycle, and you need to know what's going to keep the person from throwing in the towel and leave everybody else holding the bag. And I found that they fit pretty neatly into these five categories. The first of which is preservation of purchasing power. What's that? Well, some people, they don't have to have a W-2, any kind of job like that. They're work optional. And if you're in that situation, the way you pay your bills is from the proceeds of your portfolio. In other words, those profits that come from ownership. And if you're already in that situation, you might ask, why would you bother to make another acquisition? It's a great big hassle. There are all sorts of risks involved. And there are two big categories for when that'll happen. One is if inflation rears its ugly head Fed, it's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. The other situation is if there's distress in the property or an asset crash, it's time to start buying and buying and buying. And that is why some people are into it. Admittedly, I'm not that far in my journey yet. So my main motivation is trading time directly for wealth instead of high salary, high wage. And I've got a background in technology. I opened my CRM agency back in 2011 and did well with that. And in 2014, I started doing it for a real estate guy who was flipping 10 houses a month in Ohio, systematically, at least the transactions anyway. And as I was watching what he was up to, it hit me, I have to pivot because of the advantages of taxes and basically taking advantage of IRR, as they call it. So
Yes.
that's what I'm up to, but a lot of people, especially youngsters, that's a little too subtle for them. They're more thinking about hustling like crazy right now, fast tracking their retirement, or perhaps just taking control of their schedule. So working
Yep.
fewer months per year, fewer weeks per month, or something like that. And admittedly, a lot of people who have this as their main motivation, they believe that secretly people are just trying to hide that that's their motivation. But I assure you that's simply not the truth. Some people are fueled by ambition. They want to buy their entire hometown. They want those great big buildings with their names at the top. And the beauty of having somebody in a partnership who has that as a motivation is they're going to be hustling into their 90s. So they're great to have around. And similarly, the last group here, they also are going to hustle into their 90s, but it's not so much of their own legacy. It's not to make sure that their great grandchildren never have to hold a day job. Instead, they've picked a sector of society, or maybe it's the environment, maybe it's animals, who knows, but they've realized that there's a financial component to it, and so they make these commercial real estate acquisitions for that purpose. So, Ben, of those five different motivations, what combination of them would you say describes you best?
Man, that's tough. But it's a Venn diagram. So I'll tell you a very, very quick story. So when I was producing, our whole life, we got a reputation of building some projects and some things that were difficult, right? Like we were the problem solvers. And so we built things, we built events, we raced snow trucks or trucks on snow in Maine that were built for desert racing, like that type of thing. And even though we became very, very good at what we were doing, and even though we had put all of our ducks in a row, COVID still happened, right? Instantly, all of a sudden, everything that we built went away in a flash because I can no longer gather people. So helping other people build additional streams of income, helping other people build a safety net, as well as like I didn't quit because I didn't love it. I quit because I had a family and my boys were growing up without me. But there are so many people in my industry that still love what they're doing and other industries too, right? So if I can help them continue doing what they're good at, continue doing what they love, and then build a secondary or tertiary stream, and also provide some protection for when things inevitably change, right? Like we're in the business of not if, but when something's going to change, something's going to go wrong. We want to help you build that.
I love that answer. It's fantastic because you already addressed the fact that even though, especially in guru and mentorship programs, it's all rah, 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 rainbows and fluffy pillows. The fact is, any business has risk associated with it. And if
Yep.
you've ever been involved in one of these 506B syndications, these off-market deals, then the securities attorney in the mix, who there really should have been one because you need to file the exemption or else it's a house of
Yeah.
cards that can just pull the rug out from under you. They should have insisted that you fill out this questionnaire, this financial questionnaire, sometimes called a suitability questionnaire. And there was one question in those questionnaires that I found problematic, and it had to do with the tolerance for risk. I felt that the answers, the options, they weren't really actionable. Like I couldn't, they didn't really serve any utility. So I made my own, and it's a fill in the blanks question. There are many popular investment asset classes, but I think blank is too risky. So, Ben, it can be inside real estate, it can be outside real estate. What's too risky for you?
Is investing in Donald Trump sneakers off the table? Can I say that?
It's well, that would be an appreciation move, right? Buy low, sell high, and if the
Yeah.
seller or the buyer isn't high, oh, did I say that out loud?
Yeah. Yeah, yeah.
Exactly.
But
Yeah,
in some cases, that's the case. Sneakers, yeah, for sure.
right, exactly. I love that answer. That's hilarious. But the speaking of the numbers and the complexities, the fact is, when I first started doing these chance encounters, I wanted to do this slide, but I was concerned that a lot of people who you see in commercial real estate, they're more of the PR or the marketing face of the business, and they're not the spreadsheet junkies who are, up to their nose in these numbers and figuring these all out. But even if you are just a more or less of a promoter, you're still going to have a few of these metrics where it speaks to you more than others. Whereas the actual underwriters, they're going to say, yeah, well, all of these are important. What are you talking
Yeah,
about? And they're both equally right. But for the people in the audience who are listening and not watching, I'm going to read them all out. And then hopefully, Ben, you can give us, the top ones that stand out
sure.
for you or you rely on. They are cash on cash, IRR, cost per door, net operating income or NOI, the going in cap rate, which actually means the difference between the standard cap rate where the property is located versus what you're actually paying for it, the loan interest rate, especially if you're going to be assuming a loan, the occupancy or vacancy, which are inverse but the same thing, the average income where the property is located, the amortization period of the loan, especially if you're assuming it, and the market versus in place rents. What's the difference between those? Next is population growth, which of course bakes in a little bit of appreciation just out of pure demand. Next
Yeah.
is the sponsor record, which is how many deals have gone full cycle, how many deals are on the go right now. Then there's the waterfall split or exit strategy, which is about what's going to happen once the capital has been returned. Are you still on or are you out? And the last one I have here, even though there's more numbers that some people prefer, I have DSCR, which is debt service coverage ratio. In other words, how much of the revenue is already going out the door just because of the cost of the loan. So Ben, what are the metrics that you tend to focus in on when you're doing your first vetting of a deal?
Yeah, so I mean, I think it's a little bit twofold, right? So we operate and we also raise for the folks' deals. I think the biggest thing here, though, there's a couple that kind of go hand in hand, right? The cash on cash, your NOI, your cost per door, your going in cap rate, a lot of those things when you're starting to calculate. So the cash on cash, like IRR, is absolutely important because you can go side by side, but that is really dependent on a lot of things, right? So I don't typically take that one first. What we need to look at is the NOI and your cap rate and truly understand. And you talk about like, market rents versus in-place rents, understanding a pro forma for its reality versus what you say. So there's one actually that's not listed on your list that I would add there too, is assumed exit cap rate as well. So when you go through these places and you're looking through a pro forma, it's like, cool, what's your entrance cap? What do you think you're going to sell at? If all of a sudden you see a really elevated cap rate, that's interesting to talk about. If all of a sudden they think they're selling for 2 points under where you're buying at as well, which I've seen recently, that's a conversation I've had. That's a big alarms. Big alarms go off there as well. And when I asked this person, I'm not going to name names, but people now I've seen more often than not are citing like research or Trexie says or this person says, and it's honestly it's dangerous to me, right?
Mm-hmm.
When we have these conversations, it goes to that track record, it goes to the sponsor track record, but also the why. Like, why do you think this can happen? Why do you think you can get 2 points lower on your cap rate? Like, so to me, those I know that's a roundabout way of answering, but that leads to your cash on cash. How'd you calculate that? What's your timeline there? What's your entrance cap rate? What's your exit cap rate? How do you think we're actually going to raise these rents, and how do you think you're going to do that effectively? That is the most important thing for me as a puzzle maker and as a puzzle solver, right? Yeah, you can pull all these other levers. You can pull lending, you can pull debt, you can stack. There's a lot of ways to do that. But if the business model doesn't work to start with, you're dead anyway. No matter what your debt is, like if you can't make the business model work, it doesn't work anyway.
I love that answer, and like you got my wheels turning on exactly what kind of forces would cause compression. It's like, okay, you're depending on maybe the interest rates dropping, like that's one, or maybe you're just going to go around town and burn down the competition's apartment complexes so that there's less supply. But I don't recommend that.
Right.
I'm not eating that up like a subscribe sandwich. It looks delicious, doesn't it? It's
Uh,
It's a very subtle reminder that it's time to pull out the Dan Does Deals Commercial Core Competency Cube. And it's got the 6 different roles in a commercial real estate deal. And the real purpose is to make sure that not only can you communicate effectively on the subject of commercial real estate, but it's also to make sure that you understand how my guest fits into these deals. And if you're looking at this and going, wow, I really need to get me one of those, the good news is it's free. If you go to dandoesdeals.com, there's a great big button where you can download and print it out. And like a complete dummy, I don't even ask for your email address. That's the cardinal sin of marketing. You always ask for contact information in return for your freebie. But it's really important to me that you improve and become confident when you're talking about who's involved in a commercial real estate deal, because I think your career in this industry is going to depend on it. So you can go and print that out. So let's go through all 6 sides. The first one is the repositioner, the acquisitions person, the person who's doing a whole bunch of paperwork, looking at a whole whack of different deals. And what are they doing with that paperwork, you may ask? Well, the fancy word is underwriting. And what that really means is they're trying to find upside and they're doing the math. Part of it, of course, is figuring out if the seller slash broker is even telling the truth about how much the property is making, because okay. But one thing that a repositioner always has to do that's a little bit unintuitive is they have to have a wide network of financiers. That's people who only deal with paper and money. They are not dealing, they're not part of the GPs. They're not dealing with tenants or anything like that, the residents of the building. They interact with the owners, and that's about it. But the reason why repositioners have to have vast networks of financiers and lenders is because if you can access cheaper capital, in other words, get a cheaper loan, that goes straight to the profitability of the building. So there's your upside baked in already. But of course, there's only so much you can do as far as getting that cheaper money. So the next place that the repositioner has to look is in the operations to stop those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rent and mowing lawns or possibly even shoveling snow. One of the things that I contribute, even as an internet guy, is that first of all, there's some automations you can do in web applications and whatnot. But the bigger thing to understand is that even if you're dealing with the bigger properties, like I've been tending towards, 100 units or more, the enemy is vacancy. Okay, if you got empty units, that's going to make you hemorrhage cash. And so even if you are outsourcing the property management to a third party, if they are not filling those units, somebody with some serious marketing chops is going to have to step in and get those full. And so that's what I contribute when I'm on a GP team. But of course, there's only so much you can do as a repositioner with operations to optimize. So the next place where they frequently look is to get a contractor team involved to renovate the place, make the property nicer, and therefore the future residents are supposed to be happy to pay more in rent than the previous ones. But of course, contracting can be an endless pit of money. You could go ahead and gold plate the toilets if you so choose, but I don't think you're going to get a good ROI or return of investment on it. And if you're like me, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground, people who can be there in an hour or two, because categorically, that's not going to be me. Okay, I'd still be stuck at an airport in an hour or two. So we need to have somebody else who could keep an eye on the contracting team and the operators, especially if we have the third party property management. Make sure they're not cutting corners, sloughing details, using subadequate materials and whatnot. But let's do a little hypothetical. Let's say now you are a repositioner. You get the idea in your head of, hey, I know how to buy a house. I put down my down payment and I get the bank loan. If you're an engineer or an attorney or a physician, something like that, you might get the idea that you and your pals can each throw in like 100K or 200K or something like that. And you can take over the 350 unit apartment complex that's down the street. Well, when you get it under contract, you turn around to the financiers and say something along the lines of, hey, check out this property. It's 350 units. It's tens of millions of dollars. Do you have, say, tens of millions of dollars you want to lend us for this? Well, there's one big problem that I haven't addressed yet in this little model. And if you're in a guru program or a mentorship program or something like that, I highly encourage you to listen carefully, because the bank is going to have one question I haven't answered. And a lot of these gurus really gloss over this thing because there's secretly a big advantage for them glossing over it. It is that the bank's going to say, who's the sponsor? Who's the KP? And what's that all about? In order to be eligible for a commercial loan, somebody in the fold has to own a similar asset. In other words, if you're going to be taking over a 350 unit apartment complex, somebody has to prove that they're not going to run it into the ground. Okay. And on top of that, you also need a certain amount of liquidity. And then among the ownership team, you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Ben, it sounds like you got a few of those boxes checked. What parts of the puzzle are you most likely to contribute?
Yeah, so we didn't necessarily go over there. So like, especially in this space, right? And then 506B, we have to bring partners together. We have to bring people that bring a little bit of capital as well. So we have to go out and have conversations, build some trust, build some relationships over time, and bring some people to the table that this will benefit and be a win-win for everybody. So capital raise is a big one. I do have my hands in asset management as well. So when we go to talk about dealing with contractors, talk about having the oversight of some of these pieces in the puzzle, we have that as well. So it's a little bit twofold. All of the people in our team play a lot of roles and we wear a lot of hats, but we pride ourselves on the fact that almost all of us are capital raisers as well, because we all want to be a part of the relationship and we all want to be a part of the conversation. And frankly, it's required that we all materially participate and don't just raise money, right?
Yes, exactly. So I call that financier and financier relations because I got one securities attorney who hates the term capital raiser because it makes it sound like you're not doing asset management.
Right.
And but that's the problem, and why it's a lot of the reason why I have the format that I do here on Chance Encounters is to make sure that
100%.
we can communicate effectively. So that's absolutely fantastic. I'm really excited about that. But my next question then has to be about the buy box of the property itself.
Mhm.
And when real estate people are asking each other, hey, what you looking for? What's your buy box? What's your ideal property? We're really asking about three main things. First one's geography. Where is it? Which state? Which county? Which neighborhood? Before you call it ideal, that's going to be important. The second thing is going to be size. Most of my guests on this show are in multifamily commercial real estate, which is apartment complexes. And then the way that you define the size of an apartment complex is by the number of apartment units. It's pivotal in a lot of people's understanding because that's how they mitigate the risk. Instead of a single family rental where you only have one resident that is actually contributing to the pay, instead you have many of them and it's going to be distributed out through that. Now, in other types of commercial real estate, it's entirely possible that it's going to go by square footage, but that size is going to matter because the
Right.
type of group that takes over 5 and 10 unit apartment complexes is going to be fundamentally different from the type that takes over 150, 250 unit apartment complexes and whatnot. Now, the third one, though, I call it desirability, but the more common term is class. And when we're talking about class, the idea is you split it into two different parts, which is why I don't like the term. The first one is the condition, and the second one is the area. And when you're talking about condition, it's how old is this building, how beat up is this property, what sort of luxuries and amenities do they really have that really make the residents enjoy living there a whole lot more, or renting if it's a strip center or something like that. But when you're
Sure.
talking about the area, then it's a completely different deal because you want to consider in multifamily that the school districts where the property is located is going to be vitally important. But regardless of the type of real estate, the crime rate is going to be very important. And then, of course, there's that old trope where they say location, location, location. And what they really mean in that case is that the traffic that goes by that property in any given day. So, but both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A minus, and then B plus, and so on. So, Ben, as far as your buy box, what's easier to say yes to and more difficult to say no to?
So we look in, like I said, primarily Texas, Oklahoma, Arkansas. We are big proponents of Tulsa specifically, and in that space, we are a value add operator. So we look at B to C, mostly C minus, but the get gets pretty muddy as well. Like what one man's C plus is another man's C minus. So really, what we're looking for is, to your point, like we look at the area, look at the neighborhood, look at crime rates, and really look at trends. And there's a term called path of progress as well, and there's a lot of different ways to define that. But what we want to do is find some locations that we think we can do a little bit of good in. bring a little bit of capital. Perhaps they just haven't been able to fix some things up the way they should be. Perhaps there's some additions there. Perhaps there's a little bit of extra land. We can add some storage and really bring up the living conditions for folks that are there, and also provide some value for our investors along with it.
Awesome, awesome. And did I miss when you said the states that you're focusing on?
Texas, Oklahoma, Arkansas. So specifically, like I said, Tulsa, outside Tulsa, Fort Smith, some in Oklahoma City, but we're heavy in Tulsa, and then North Little Rock specifically. So again, the location and block by block is important in understanding that space. But yeah, we love those spots.
All right, beautiful. So let's talk about people then. And my favorite part about commercial real estate is that because people are so eager to build these new teams, because it's a team sport after all, giving referrals and whatnot, it's really, really great. But at the same time, we all have our own unique skill sets. So when we're going to be part of the team, we're better off helping some people more than others. And me personally, traditionally, I've always been eager to meet more sponsors and KPs because they've already got that deal flow that'll make a big difference. Of course, everybody in this industry needs a vast network of financiers, and I'm always eager to meet everybody in the context of the show. But Ben, I think you're not going to mention any 506B deals you have specifically, so that makes it okay to mention financiers and wanting to meet more of them. But who's out there in the audience that you really want to talk to?
So we love to talk to more brokers and more financiers. Like you said, the more to the table, the merrier. We have some great relationships. Operators that are doing some interesting things. We think that there's more than enough for everybody in this space, right? We're an open book when we operate. We're not hiding secrets. If you're working in Tulsa, we want to meet you. If you're working in North Little Rock, we want to meet you. The more that we can work together, and honestly, more deals get done in the white space, in my opinion, than anything else. So if you're doing something, or if you have a question of us, we're more than open to talk about it. And the last thing I would say is, there's this term capital raisers that gets thrown around. We learned by doing. We had some excellent coaches. We had some excellent mentors. We had some people we work with, and truly, there's no other way to work than to getting into a deal. So if you're interested, if you say, hey, I really want to learn this space, like reach out to myself or reach out to another experienced operator and start asking some questions. So we would love to hear from people who are getting started as well.
I love that, especially when you're talking about the more premium coaching programs or whatever. You could really get a better education by investing than you do by putting 5 figures.
100%.
Yeah, because if it's tough to just try and get educated through YouTube or something like that for free because there's as much good information.
I'm a prime example. The way that I came into this, like who I thought I was going to be coming in and who I've actually become in this business has changed. And I think that's the case for all of us over time. And I think it will continue to evolve because investing will evolve, the markets will evolve, the products will evolve, the tenant base will evolve. So if you're asking if you should jump in, if you got attention, it is possible to learn the lingo, learn a little bit, get a baseline, but man, just reach out to somebody who you jive with, who you get along with, who you think speaks your language, start asking them questions. And if they say no, if they won't help you, give me a call. We'll sort you out.
Yep, I love that. I love that. So the next question has to be how to reach out then. And I'm lucky enough to have a super duper distinct last name. Makes it really easy to find me, especially on LinkedIn where I spend most of my time. And of course, if you want to buy some books, that's on Amazon. But I want to draw attention, especially if you have your phone handy. If you scan this QR code right here, that brings you to the FAQs page of 506BME, which is the platform I created to document your substantive relations with your investors. The idea being, do you have a plan for if your laptop falls into the bathtub and the SEC audits you? They need to see that proof that you knew people before you started pitching them your deals. So that's what that's for. But Ben, if we ended up meeting in Phoenix at a conference, but LinkedIn is great for me. But social media, email, phone, what are the best ways to reach out?
Yeah. Social media is great. So LinkedIn and Instagram are both Ben Nelson 303. I live in Colorado, born and raised in Colorado. You reach us there, or you can reach out to wildoakcapital.com. That's wildoakcapital.com, and you'll see the bios and easy ways to reach out to us there as well.
Perfect. And that brings me to the last part, which is the public service announcement. It's not for you, Ben. It's for you and the audience. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like maybe like migraine like symptoms, I'm confident it's because there's a downright hideous subscribe button right there that you can get rid of for free by just clicking on it. And full disclosure, I want people to click on it because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. But of course, the compensation or the difference that it makes when you are subscribed, it just means that my videos may show up on your list of suggestions. But you can feel free to ignore those suggestions because quite frankly, I just appreciate the fact that you spend this time with me. Just like Ben, I appreciate you joining me. This has been great.
Thanks for having me, man. I appreciate it a lot.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.